Good evening. Please come to our chapter Capital Market Primary. We have discussed the different types of issues. Two main issues we have covered: initial public offer, further public offer. And under that, we have also discussed the right issue and the benefits of right issue to the company. Okay. Now you see point number C, composite issue. Composite issue is a combination of public and right issue. Composite issue is a combination of public and right issue. That means simultaneously they will announce a public issue also and right issue also. Simultaneously they will announce the public issue also and right issue. Public issue is open for everybody. Right issue is for existing shareholder. Okay. Point number C, where the issue of shares or convertible security by a listed issuer on public cum right basis, wherein the allotment in both public issue and right issue is proposed to be made simultaneously, it is called composite issue. Both right issue and public issue is made simultaneously. Now you write down few lines from my side, also called right cum public issue. Also called right cum public issue. Paragraph C, also called right cum public issue. What are the options before the shareholder? This diagram also you draw. What are the options before the shareholder in a composite issue? The option before the shareholder is only apply to the right shares. Only apply to right share, which he will prefer. Because right issue would be priced below the public issue. Or he can do both. He will take up the right issue, whatever right shares are offered to him, and if he wants he can also subscribe to public issue. Also subscribe to public issue. Take up the right issue and also subscribe to public issue. Third, opt for only public issue. Opt for only public issue. An unlikely scenario. An unlikely scenario. Okay. Why unlikely scenario? Because first he will give preference to right issue. But still that option is available. And the fourth one, ignore both. Neither apply for right issue nor apply for public issue. So ignore both. Noted? Have you done yesterday's homework? 10 companies which have issued ADR. Who has done? Wait. I will write down so that other student can also write down. Yesterday I had asked one student to do this homework. ADR issuing companies. So one student, good student, has done the homework. Very rare nowadays. Infosys, Wipro, HDFC, WNS Global Services. Those who want to write can write. Vedanta Limited, and that I had told you, Make My Trip. Satyam is also there. Now it is not there. Then Infi, Sifi technology was there. It was called Sifi. Sifi technologies. Then Dr. Reddy's laboratory. Wow. And Rediff is also there. When will AS Foundation come? Soon. Then ICICI Bank is also there. Tata Motors is also there. You have written more. Last answer will not be checked. If you write more than required answer, excess answer will be ignored. Okay. So he is a good student. So now today one more homework for you. Which companies have issued composite issue? Try to find out. Do some R&D on your own. And next homework you write on name about 5 companies which have issued bonus shares in the recent past. Okay. In the last few years, the bonus shares have been issued by many companies. So what you will do, you will find out the name of 5 to 10 companies which have issued bonus share and try to find out if any company has issued composite issue, and also few companies which have issued right shares. Okay. Composite issue is public cum right issue. So public issue means you have to private placement the right issue. We have to see the SEBI guideline whether they will allow you Airtel Bank, India Airtel or South Africa Airtel. I'll just check. I'll just check because unless I check, I can't say with commitment. So his question is, can preferential allotment and right issue be issued together? So composite issue will always be public cum right issue, right and public. So it has to be issued to public. Preferential allotment is not issued to public, it is to selected investors. Now next is your favorite topic of intermediate, bonus shares. Bonus shares are issued without any consideration based on the number of shares already held by them on the record date. Record date means the date will be fixed by the company to identify the shareholder who are members of the company on this date. And after that list is finalized, they will be issued bonus share. Good news. That is why this person is laughing. Okay. No consideration has to be paid, but he will get shares. Is it a matter of laughing? No. Immediately after bonus issue, the share prices will fall down proportionately. Immediately after the bonus issue, the share price will fall down proportionately. If it was 100 rupees before bonus issue, and now the bonus issue is 1:1, the share price will become 50 because the same market capitalization will be divided by double the number of shares. So he will be holding 2 shares of 50 rupees each now. But at least psychologically, mentally, he feels happy. Okay. And therefore he will laugh. But he does not know the value of his shares have gone down proportionately. But company issuing bonus shares indicate to the market that we are a profit making company, we have a huge reserve, we have a future potential, and this acts as a signal to the market. This acts as a signal, and because bonus issue has a positive effect, shareholders indirectly benefit from that because company which issues bonus share, their share price usually appreciate. So hence bonus shares are beneficial to the shareholder. These shares are of 2 types. So shares are issued out of, bonus shares are issued out of either free reserve or out of the share premium account, or maybe out of capital redemption reserve account also. One more thing, right? We teach in accounts batch. Bonus share can be issued out of capital redemption reserve as per Companies Act also. Bonus shares are issued in a certain ratio, so every shareholder get proportionate share. Does bonus share change the shareholding pattern? So you can add from my side, bonus share does not change shareholding percentage. If you are holding 50% share before bonus issue, you will continue to hold 50% share after the bonus issue. Although the number of share will double, but it will be doubled for everybody, not just for you. One more line, right? Also called stock dividend. Also called stock dividend. Also called stock dividend. Also called stock dividend. It's more a US term, stock dividend. In India, we call it bonus shares. That is, dividend is given not in the form of cash, but in the form of shares. Now, question is advantages of bonus issue. Why do companies prefer bonus issue? Because there is no cash used here. It preserves the liquidity of the company. You just have to pass a journal entry. You are a student of accounts also. Reserve account debit to share capital account. So shareholder is also happy. He's getting shares free of cost. Company is more happy. It is not paying any cash to the shareholders, and still shareholders get the impression that he is getting rewarded. Dividend distribution tax is also saved, but for that we have to see the company income tax laws. Is it right? But when they will sell the share, that time they will have to pay the capital gain tax. But at least for the time being, stock dividend, that is a US terminology. In India, it is called bonus share. So, as one student is saying that company does not have to pay dividend distribution tax also. Yes, you are right. But check the Income Tax Act for this. I am not 100% sure, but I think you are right. The shareholders can liquidate the shares whenever they require. Yes or no? Is there any lock-in period for bonus share? No. Once the bonus shares are transferred to your demat account, you can sell it. But of course, you will have to pay capital gain on that. It is an excellent way to bring the paid up capital of the company in line with the actual capital employed by the company in the business. Okay. So some companies paid up capital is 1 lakh and reserve is 20 lakh. So it seems that the paid up capital and total shareholder fund are far away from each other. So what you can do, you can transfer some amount from reserve to capital. So paid up capital will become more in line with the actual capital used by the company. But major reason why company issues bonus share is for point, it improves the image of the company. Such companies get more respect from the investors community. It gets a lot of media attention also. Okay, and if it is believed that this company is going to issue bonus share, more and more people buy it because they have a confidence in the company. It broadens the capital base of the company. It is an inexpensive method of raising the capital. Reserves belong to shareholders. So what you are doing actually, you are converting the shareholders reserve into your share capital without incurring any cost. Is there any issue expense, flotation cost, underwriting commission? No. No cash reserve of the company is used. Cash reserve is conserved. Bonus share will reduce the market price of the share. This is an advantage, not a disadvantage. Bonus share will reduce the market price of the share is an advantage. How? Now the price per share will go down. The price per share goes down, and shares become more liquid. More trading can take place in the share. More and more investor may purchase the share. If the price of a share is say 50,000 rupees per share, will you buy? You will say, no, my stipend is only 5,000 rupees. I can't put 10 months stipend in one share only. But if the company goes for say 100:1 bonus share, so the value of the share will become 500 rupees now. Example, now you can purchase 10 shares from your 1 month stipend. Okay. Earlier you required 10 months to buy one share. Now in 1 month stipend 10 shares you can buy. So those who are earlier away from the company because of high price, they will also come into the market. Liquidity will increase, trading will increase, prices will be more efficiently determined. And one more important reason why bonus shares are issued, it is perceived as an indication by the market that the company's financial position is sound. Many companies use bonus share only to give a signal to the market that yes, we are a good company, strong company, financially sound company. Although mathematically speaking, there is no real change. The total paid up, total shareholder fund remains same. Total market capitalization will remain the same. Earlier shareholder was holding one share of 100, now he may be holding two share of 50 rupees each. But it gives a signal to the market. But there are disadvantages also. Since the reserves have been used to issue bonus share, it indicates that future dividend would decline, possible. But again, it may vary from company to company. Some company may still maintain the same rate of dividend even after the bonus issue. Next is, one student is saying EPS will go down. How does it matter? Number of shares will double. So as a shareholder, my stake in the earning will remain the same. EPS will go down. Yes, you are right. But my stake in the total earning will remain same. Earlier I was getting one share, 6 rupees EPS. Now two share, 3 rupees EPS. So my stake in the earning, my stake in the dividend, my stake in the market capitalization of the company would remain the same. But yes, some shareholders may feel that the reserves have been utilized to issue bonus share. Company's ability to pay dividend has reduced and therefore I might get less dividend. Some investor invest for the sake of receiving dividend also. It gives them a regular income every year. Issue of bonus share may involve long, lengthy legal procedures and approvals. Board of directors have to pass resolution, shareholders will have to pass the resolution, okay, etc. Now we will understand what will be the price of the share after the bonus issue. So the formula is S into P0 upon S plus N. What is S, P0 and N here? S means the number of share outstanding before bonus issue. P0 is the current market price. N is the number of bonus shares issued. Now suppose I ask you to solve a small question right there only. Suppose number of share outstanding before the bonus issue is 1 lakh. Current market price is 50. And number of bonus share issued are also 1 lakh. 1:1 ratio. 1:1 ratio. What will be the post bonus price? Post bonus price will be 1 lakh into 50. This was the market capitalization before the bonus issue. Because of bonus issue, market capitalization will not change because the company is the same. It is just a book entry. But the number of shares will double. Same market capitalization is divided by double the number of shares. 50 lakh divide by 2 lakh is 25 rupees. So if you are a holder of one share earlier, your wealth was 50 rupees. Now you will be holding two shares of 25 rupees. So your wealth will be again 50 rupees. So there is no immediate impact of bonus shares on the wealth of the shareholders. This you have to know, because many people start dancing in rain when they hear that they have received bonus shares. Give this example to them. Tell them you can dance, no harm, but not because of bonus share. Because your wealth was same before and after. There is no immediate impact of bonus shares on the wealth of the shareholder. But what happens as the liquidity increases? As the people get the news that this company is issuing bonus share price generally rises, I have observed, and therefore there is an indirect benefit of bonus issue. Now you have to write a note in the notebook, which is not given in ICI material. Differences between bonus share and right share. Differences between bonus shares and right shares. Okay, so I have made a comparison chart. 3 points we will write. Draw this table. First column write serial number. Second column basis of difference. Third column bonus shares. Fourth column right shares. First write down serial number 1, basis of difference, meaning. Bonus share means the shares which are issued to existing shareholders from the profits and reserves of the company without taking extra payment, without making extra payment. You can just write without making extra payment, and then write down the shares which are meant for existing shareholders are called right share. These are issued at a consideration. So basically the difference is bonus shares are issued without consideration, right shares are issued with consideration. Both are issued to existing shareholders. Objective, write down. Issue a bonus share. Issue a bonus share implies the payment of dividend in the form of shares. Okay. Issue a bonus share implies the payment of dividend in the form of shares instead of cash. That is why sometimes in some countries it is called stock dividend. Okay, because instead of paying dividend in cash, you are paying stock dividend. But in India they don't use the word dividend, otherwise government will come behind them and ask for DDT. So they call bonus share. And in case of right share, the object of the issue of right share is to increase the subscribed capital of the company, to raise funds for the company. You can write to raise funds for the company. Issue of right share objective is to raise the funds for the company and it will increase the subscribed capital of the company. Written second point. These 2 points are enough. Okay, so I hope you have written. Now I am going to discuss one more point. Differences between bonus share and share split. Write down additional point, additional difference. That is already covered in the first point. Third point was repetition. Just we'll read it and go ahead. Third point is consideration. Bonus shares are issued to existing shareholders without any extra consideration. That was written in the meaning also. And right share payment is made by shareholders subscribing fresh capital. That is also written in the first point. So I'm not dictating again. Now write down differences between bonus shares and share split. Is bonus share and share split the same thing? In share split, a share of higher face value is divided into shares of smaller face value. Okay. So the common thing is that in both cases number of shares will increase. But in bonus share the face value will remain the same. But in stock split the face value will go down. Second, in bonus share your reserves are converted into share capital. In share split reserves are not touched. Only the number and the face value undergoes a change, keeping the total constant. Right? So write down a small note on share split. And bonus issue. 3 points write down. These can be some true false MCQ fill in the blanks questions. Some share split bonus issue. Point number 1, same share being divided into 2 or more shares. Same shares being divided into 2 or more shares. So today we will find out which are the important companies, main companies which have gone for share split. Many Indian companies have gone for share split. Like for example, Infosys face value was earlier 10, then they have reduced it to 5 rupees and number of shares have doubled. Say for example, Wipro, Jain Irrigation. The reason is that it reduces the market price proportionately. It reduces the market price proportionately. Like bonus share I have discussed, shares become more liquid, more tradable, more people can participate. Okay. And then what about bonus issue? Already covered. Issue of free additional shares. Issue of free additional shares. Full stop. Bonus issue in place of cash dividend payout to conserve cash. Bonus issue in place of cash dividend payout to conserve cash. Yes, market value changes in both cases. Market value goes down proportionately in both cases. For example, if this is the share split, market value will become half. And if bonus share is in the ratio of 1:1, market value will become again half. Is it right? So market value will fall proportionately in both cases. Second, write down no change in share capital. Share capital will remain the same. For example, earlier it was, let us say, 10,000 share of 10 rupees, 1 lakh. Now it will be 20,000 shares of 5 rupees. So it will still remain 1 lakh. But in case of bonus share, share capital will increase, reserves will decrease. Bonus issue capitalization of reserve into share capital, resulting in an increase in share capital and a corresponding decrease in distributable reserve. Okay, agreed. And a corresponding decrease in distributable reserve. Point number 3, write down proportionate fall in par value. Like this example, 10 will become 5. If you want to keep the share capital same and you want to issue shares of 5 rupees, no change in par value. Here face value before bonus issue and after issue will remain the same, that is 10 rupees. Okay, just write one note below. Note, in both cases the market value of the share will fall proportionately. So what is common? The market value of the share will fall proportionately in both cases. The market value of share will fall proportionately in both cases. Point number 4, difference random. There is one more point. I can take this also. Point number 4 below, right? Last point. Today you don't have to write much. Share split, proportionate fall in dividend per share. Proportionate fall in dividend per share due to enlarged share capital base. Due to enlarged share capital base. Due to enlarged share capital base. No change in total dividend payment by the company. No change in the total dividend payment by the company. Okay. How this will be possible mathematically? Suppose a company pays 10% dividend. Suppose a company pays 10% dividend. It has 1 lakh share of 10 rupees each. So before share split, the company was paying dividend of how much? 1 lakh rupees. After stock split, we presume that dividend rate will remain same. Now this company will have 2 lakh share of 5 rupees each. So my answer is dividend will still remain the same. Okay. Will the shareholder be affected? No. He will get the same amount of dividend. Earlier he was getting dividend on one share, 1 rupee. Now he'll get on each share 50 paise, total dividend will be 1 rupee only. In bonus share, if the company maintains the same rate of dividend, dividend of the shareholders will go up. Okay. So maintain same level of dividend per share, resulting in increased total dividend payment by the company over an enlarged share capital base. Noted? Now see the example. Suppose company has 1 lakh share of 10 rupees each before bonus issue. Dividend rate is 10%. So before bonus issue, the company was paying 1 lakh rupees dividend. After bonus issue, what will happen? The number of shares will increase 2 lakh, but face value here will be the same. So this time the dividend will become 2 lakh, assuming that the rate of dividend remains the same. But now again we are making an assumption here that the rate of dividend will remain the same. Some companies might reduce the rate of dividend. So we have discussed how many types of issues. Once again, public issue, then under public issue we had IPO and further public issue. Okay, then we have right issue, composite issue, bonus issue, and some additional discussion for understanding on share split. Now we'll come to private placement. As the name indicates, that these shares will not be issued public at large. These will be issued to selected group of investors. Private placement, that is, company will issue share only to a certain set of investors. But again, since you are issuing shares, you have to comply with SEBI guideline if you are a listed company. Okay. So now next few paragraphs you will find there are long lengthy paragraphs which some portion of SEBI guideline is also covered here. So what I am going to discuss in the next few pages will cover some SEBI guidelines also. Understood? So do you need to remember all this? Yes, you have to. But good news, if it is an open book exam, you can come back and refer. But you should know that this item or this answer, I am going to find it over here. Okay. So better you read, understand, and then go to the exam. Easy to write the answer. So I have seen the questions which are from any corner of SEBI guideline. Okay, like this question: when an issuer makes an issue of shares or convertible securities to a select group of persons, but then there are some numbers which you have to keep in mind for some true false type question, fill in the blanks question, or a MCQ question, or a short question. When a company issues shares or convertible securities to a select group of persons, not more than 50, but can extend up to 200, and which is neither a right issue nor a public issue, it is called a private placement. So this is the definition of private placement: shares or any other convertible security issued to a selected group of persons whose numbers usually cannot be more than 50, but in some cases it can be extended up to 200, and it should not be a right issue or a public issue. Private placement of shares or convertible securities, underlined, by listed issuer are of three types, because SEBI guideline deals with whom? Listed company. If it is a listed company, then there are SEBI guideline on private placement, and there are three types of private placement SEBI has understood. So private placement can be of three types. Which three types? One is called preferential allotment, then QIP, qualified institutions placement, QIP, IPP, Institutional Placement Program, Private Preferential Allotment, QIP, IPP. So my next discussion will be on preferential allotment. Printed in your notes. For a few minutes you can enjoy, no need to write. What is preferential allotment? Questions are asked from this corner also. What is preferential allotment? So for listed company you have to write the SEBI answer, not your own answer that it is issued to private parties. When a listed issuer issues shares or convertible securities to a select group of person, okay, this is a general answer. Listed company issuing shares or securities to selected group of person. But then you have to also write in terms of provisions of Chapter 6 of SEBI ICDR, write full form of ICDR, issue of capital and disclosure requirement. In case if you want to write what is ICDR, this SEBI guideline is a part of syllabus. If shares are issued to selected group of persons under provision of Chapter 7 of SEBI ICDR regulation, in short it is called SEBI ICDR regulation 2009. Full form of ICDR is issue of capital and disclosure requirement. It is called preferential allotment, which means companies have to comply with Chapter 7 of SEBI ICDR regulation. The issuer is required to comply with various provisions which inter alia include what are the compliances? You have to comply with the pricing requirement. You have to comply with the disclosure. Spelling is wrong. Disclosure. Then disclosure in the notice. You have to comply with the lock-in period, etc. In addition to the requirements specified in the Companies Act. The last chapter deals with SEBI guidelines, where you will see in detail all these guidelines. So refer SEBI guideline for preferential allotment, chapter 7. Okay. Now next is what is QIP. Q stands for qualified, I for institutions, P for placement. So from the name you can understand that these issues will be placed to some qualified institutions only. Some qualified here means again those which will be complying with the SEBI requirement. Whatever conditions SEBI will fulfill, ask them to fulfill. If they are willing to fulfill, then they come under the category of qualified institutions, and the allotment of shares here will be called QIP. So you will find there is a long paragraph there, A, B, C, D, E, etc. These are the SEBI guidelines. So you have to keep in mind there is no choice. I have seen the questions from the exam come from this paragraph also. So when a listed issuer issues equity shares or non-convertible debt instrument along with warrants and convertible securities other than warrants to QIP only in terms of provision of chapter 8. What was chapter 7? Chapter 7 was preferential allotment. Everything is ICDR. So suppose in the exam the question can be chapter 8 deals with private preferential allotment. Chapter 8 deals with preferential allotment, true or false? False. Chapter 8 deals with QIP, true. Now what is QIB? I have written 2 lines. If you want to write, you can write. Do you want to write? Yes, write down. I am trying to add some more information. QIBs. Who are QIBs? QIBs are generally perceived as institutions with expertise and financial power. That allows them to evaluate and participate in capital market. So these are institutional players. They have more knowledge. Okay, they have more power. They have more expertise. They know what is the amount at which the share should be bought. So they are like sophisticated investors, well aware investors. Why do companies will prefer QIP or QIB route? QIP save time. Yes or no? Why? Because instead of dealing with lakhs of investors, you have to deal with only selected investors, say 50 investors only. It saves times and can be issued and raised capital far quicker than an FPO. So you can say cheaper and faster. In two words, funds can be raised at a lower issue price. Funds can be raised much faster than going for a follow-on public offer. This is because QIPs have far fewer legal rules and regulations. QIP have far fewer rules and regulations. Is it right? This is just extra information. These are the institutions which have financial power, knowledge, expertise, awareness. So they bring more confidence in the financial market. And from company point of view, instead of dealing with lakhs of investors and going for long legal lengthy formalities, you can just deal with few QIPs. Now this is a part of SEBI guideline, conditions for qualified institutional placement. In order to protect the interest of all investors and other stakeholders, some rules and regulations are there for QIPs. Otherwise, companies may try to manipulate the price or the market and get benefit. Okay, so listed issuer may make qualified institutional placement if it satisfies the following condition. First is, it's not very easy because you have to pass a special resolution. You are not asking the existing shareholders to contribute. Since you are going to directly take money from other investors, the stake of the existing shareholders will go down. So companies will have to pass a special resolution approving the qualified institutional placement has been passed by the shareholder. So first shareholders have to pass a special resolution, which again, depending upon how the shareholding pattern of the company is distributed, it may be easy or it may be difficult. Second, the equity shares of the same class which are proposed to be allotted through QIP or pursuant to conversion or exchange of eligible securities offered through QIP have been listed on a recognized stock exchange. Same class of shares should be listed on a recognized stock exchange which you are going to issue to the QIP, having nationwide trading terminal for a period of at least 1 year prior to the date of issuance of notice to its shareholder for convening the meeting to pass the special resolution. That is, that share must already be in existence, must be traded on a stock exchange for at least a period of 1 year. 1 year counted from which date? The date the notice was issued to the shareholder convening the special resolution meeting. Then the third condition is QIP shall be managed by a merchant banker or merchant bankers who are registered with board. Which board? Companies Board or Security and Exchange Board of India? What do you mean by board here? SEBI, right? SEBI. Huh? In case if you get confused, who shall exercise due diligence? So you have to appoint merchant banker who will conduct due diligence. Merchant banker should be registered with SEBI. QIP shall be at a price not less than the average of the weekly high and low of the closing price of the equity shares of the same class quoted on the stock exchange during the 2 weeks preceding the relevant date. So it will be based on average price of last 2 weeks. Okay. So again, you can't manipulate the price. Of course, you can do it if you start doing it 2 weeks before. Okay. But now it is not that easy. Stock market is very big. Is it easy? Yeah. In India, everything is possible, huh? Yes, now it is not that easy because of technology. You can understand who is buying, who is selling, how many shares they have bought, which group is buying. So, in case if you are found to manipulate the prices, then the penalties are severe. So, 2 weeks is a good enough time because one day, particular day, the share prices can be too high or too low, and therefore they have taken average of the high and low price of the last 2 weeks. Anyway, just keep this in mind. Don't take much tension, right? The minimum number of allottees for each placement of eligible securities made under QIP shall not be less than 2, where the issue size is less than or equal to 250 crore rupees. So how many minimum QIP you require? 2 if the issue size is less than or equal to 250 crore, or 5 where the issue size is greater than 250 crore rupees. Again, you don't want that shareholding should get concentrated in few hands only. Shareholding should not get concentrated in few hands. So probably, and if there are many people, then there will be a competition also among them for pricing purpose. Point number F. The aggregate of the proposed qualified institutional placement and all previous QIP made by the issuer in the same financial year. That means if in 1 year there is more than one QIP, so proposed QIP and previous QIP in the same financial year shall not exceed 5 times the net worth of the issuer as per the audited balance sheet of the previous financial year. So this is a number limit. Proposed, okay, plus previous should be less than 5 times net worth. Net worth will be calculated as per the audited balance sheet of the previous financial year. Okay. So if you suppose my current financial is 2019-20, you will check the net worth on 31st March 19. And if in 31st March 19 my net worth is 100 crore, example only, into 5, 500. So my total QIP in this financial year shall not exceed 500 crore. Is my interpretation right? Total aggregate of proposed. Now I want to raise suppose 200 crore. Previously I have raised say 290 crore. Then it is okay. of the proposed QIP and all previous QIP by the issuer in the same financial year shall not exceed 5 times the net worth of the issuer as per the audited balance sheet of the previous financial year. No, it can't be find evident because proposed plus previous. So proposed itself cannot be more than 500. First time also issuing, it cannot be more than 500. No? Proposed plus previous. Previous is 0 plus proposed cannot be more than 500. No, because every time this formula will apply. No? Arey dear, you are not understanding. Suppose you are issuing for the first time only. Previous is 0. Na? My formula will be same. Proposed plus previous. Suppose it is first time. So previous becomes 0. So proposed cannot be more than balancing figure 500. Na? This total should not be more than 500. Now suppose you have issued 300 this time. So next time this 300 will come here. And you want to raise, you can raise only 200 next time. But suppose you raised only 100. So now my total amount already used is 400. So my third time I can only go up to 100 crore. So even on the first time, you cannot raise more than 500 in our example. The tenure of the convertible or exchangeable eligible security issued through QIP shall not exceed 60 months from the date of allotment. So in case if you are issuing any convertible instrument or exchangeable eligible securities, then it can be issued for a maximum period of how many years? 5 years. 60 months means 5 years from the date of allotment. So that 5 year will be counted from date of allotment. The last is eligible security allotted under institutional placement shall not be sold by the allottee. That means the QIB, the qualified institutional buyer, will not be able to sell this security for a period of 1 year from the date of allotment except on a recognized stock exchange. But on a recognized stock exchange you can sell. Otherwise you cannot sell it for a period of 1 year. Is it right? So these are the restrictions on QIP. Now there is IPP, which is similar to QIP. IPP is similar to QIP. When a listed issuer makes a further public offer of equity share or offer for sale of share by promoter or promoter group of the listed issuer, in which the offer, allocation and allotment of such share is made only to qualified institutional buyer in terms of underline chapter 8A. The earlier one was chapter 8. Chapter 7 preferential allotment, chapter 8 QIP, chapter 8A IPP, for the purpose of achieving minimum public shareholding. What is the purpose? For the purpose of achieving minimum public holding. Now what is the meaning of minimum public holding? A listed company should have a minimum public holding of 25%. Do you know that? SEBI has a regulation which says if you are a listed company, 25% of the share should be with the public, non-promoter group. So in case shares are issued, okay, by the company or offer for sale by promoter or promoter group, in accordance with chapter 8A of SEBI ICDR regulation, for the purpose of achieving minimum public shareholding, then it is called IPP. If you are a listed company but you don't have 25% or more share with the public, then it will be delisted. Yes, some Tata group companies, Wipro, yes, even government companies in last few years, if you take a close look, some government companies have also issued shares. Why? Because now it is also applicable to public sector company which is listed on the stock exchange. So even they have to sell some shares so that minimum public shareholding will be 25%. So if that is the objective and you comply with chapter 8 of SEBI regulation, it is called IPP. In both cases, we are issuing share to QIB, qualified institutional buyer, but here under chapter 8A to achieve minimum public holding. What do you mean by offer for sale? Underline here. And then I'm going to give you a meaning of offer for sale, which in short is called OFS. Right. Extra information. What is OFS? Offer for sale. It's like a block deal. It's like a block deal. Promoters or promoter group sell the shares. Generally, this is done nowadays to achieve a minimum public holding of a listed company. Right, I have written extra information below. OFS mechanism is used. OFS mechanism is used only when existing shares are put on the block. Only when existing shares are put on the block. Only when existing shares are put on the block. So who is entitled for offer for sale? Only promoters. Only promoters or shareholders holding more than 10% of the promoters or shareholders, those who are shareholder holding more than 10% of the share capital of the company, can come up with such an issue. Can come up with such issue. That is offer for sale. This is like a bulk sale. Okay, sell it to few investors instead of selling it to the public, and it is used by promoter group to achieve the minimum public shareholding to comply with the SEBI guideline that if you want to be a listed company, at least keep 25% share with the public. Then what is the point in getting listed if all shares are held by the promoters only? It will bring more transparency also, because more people will now be scrutinizing the activity of the company. Is it right? More liquidity will be there in that counter. Prices will be more accurately determined. Now there is a long discussion on type of offer documents. Very interesting. So after learning this paragraph, you will understand how the legal procedure in India works. Whenever a company wants to issue the shares, what are the work these merchant bankers, brokers, underwriters have to do? So what is offer document? Offer document is any document which contains all the relevant information. When you go to buy a product, they give you a catalog. Yes or no? That is also an offer document. When you go to take admission in a college, they give you some information in a booklet. That is also offer document. In case of company which wants to raise money, they have to give information to the shareholder. Otherwise, how will the shareholder know? Who are the promoters? What is the profit? What was the past history of the company? What do they manufacture? What is their future vision? Is it right? So therefore, it is now mandatory to submit offer documents to SEBI, registrar, stock exchange, shareholder, etc. So we'll see one by one. Offer document contains information about company, promoter, projects, financial detail, the objects of raising the money, the terms of the issue, etc. Means they can contain many more details. Right now, we'll not go into each and every detail. Lot of details are there, profitability, etc. And is used for inviting subscription to the issue being made to the being made by the issuer. So you can say this is like a offer you are making to your shareholder. See, this is our company. These are our details. Read this, understand it. If you like it, buy it. Okay. So it's like an attractive brochure nowadays. Prospectus has become like a marketing tool. Okay. With all colors, photographs, and anything which can attract the investor, it is printed there. So offer document is called prospectus in case of a public issue. An offer document is called letter of offer in case of a right issue, because it is not offered to public in general, it is offered to existing shareholder. So remember these two names: prospectus for public issue, letter of offer for right issue. Term used for offer documents vary depending upon the stage or the type of issue where the document is used. So I'm going to discuss many types of offer documents. The name will change depending upon when are you issuing it and what is the type of issue. Like for example, there is a draft prospectus, draft offer document. There is a red herring prospectus. Yes or no? Prospectus, sell prospectus, etc. So more or less all of them are same, more or less, because all of them basically contain the information about the company. But when they are issued, to whom they are issued, and what do they contain, let us see. So draft offer document. Why this word draft is used? It's not final. So when a company wants to raise money, it has to submit the offer document with the SEBI. Why SEBI? Because SEBI is the regulator, capital market regulator. They will check it. It is like you have done some work, your boss is going to check it. And if SEBI suggest any changes, then after incorporating those changes, it will be filed with the ROC. So this is called vetting by the SEBI. VETTING. Okay. So whatever you have written, it will be vetted by the SEBI. That is why it is called draft. And once SEBI goes through it, it may recommend some changes also. After incorporating the changes recommended by SEBI, then it is submitted to ROC. Of draft offer document is made available in public domain. You can also see it. Where can you see it? In the website of SEBI, concerned stock exchange, concerned merchant banker, for enabling public to give comments if any on the draft offer document. So even public can submit their comments. Now RHP, have you heard RHP? When? In the intermediate law, IPCC or intermediate, both are now same. So tell me, because I don't know, you have to guide me. What is RHP? The detail. It is also like a prospectus only. It contains little less information than the prospect. It is submitted to whom? To the shareholders or to the ROC? Shareholder. Okay. You are getting little confused here and there. It is an offer document used in the case of book built public issue. What is book built public issue? Will take later. It is called book building, where the public is invited to decide the price and the number of shares. Huh? Yeah, it is filed with ROC. It contains all the relevant details. Like prospectus, it contains all relevant details, but except that of price or number of shares being offered. Because when we go to ROC, that time we are not sure what will be the final price. Final price will be known after all the investors who want to purchase the share have submitted their bid, and the board of directors will sit down and decide what is the best price at which we should issue the share, so that our objective is satisfied of raising a certain amount of funds. And number of share will also be known only after the price is locked. So many times it is containing all details like prospectus, but because in book building the price and number are not known, it is not mentioned. It is filed with ROC. Somebody said with the shareholder. ROC before the issue opens. D. On the other hand, an issuer can state the issue size and the number of shares are determined later. This you write down. You can only mention the issue size in the RHP. What is issue size? You say we want to raise 3000 crore rupees. Now what will be number and what will be price will be determined later, because once the price is determined, the number will be determined, because this 3000 crore is a product of number and price. So you can disclose the issue size. Mostly they say this company wants to raise 10,000 crore rupees for this activity. Many times they specify the numbers also, but it can be specified later. So we have seen two documents till now. First one was draft offer document, which is filed to SEBI first for checking and suggesting any changes. Then we file RHP with ROC in case of book building public road. Okay. Now next is prospectus. It is an offer document in case of public issue, and it has all the relevant details including price and number of shares or convertible securities being offered. This document is registered with ROC when before the issue opens in case of fixed price issue. In fixed price issue, all price and numbers are already known. So you can submit this to ROC. But in case of a book building route, price and number is not known. It is known only after the bids have been collected, allotment is made. So therefore prospectus will be submitted after the closure of the issue in the case of book build issue. Then what is letter of offer? Did we come across this word letter of offer earlier? Letter of offer we have discussed when company wants to raise money by right issue. So it is an offer document in case of right issue of shares or convertible securities, and it is filed with stock exchange before the issue opens. Draft prospectus, SEBI. Okay. RHP, ROC. Prospectus with public and with ROC also. In case of ROC, in case of fixed price before the issue opens. In case of book building mechanism after the closure of the issue. Letter of offer is submitted to stock exchange. Okay, now next is abridged prospectus. Have you heard this word abridged? What is abridged? Small or big? Abridged means small or big. It's like a summary. Okay. So instead of giving a detailed prospectus, which will be running into hundreds of pages with all technical and legal details, and many times the investor may not have so much of time and energy to go through such detailed prospectus. what you can do, you can issue an abridged prospectus in public issue, which will contain all the key details of prospectus. It is an abridged version of the offer document in public issue. It is issued along with application form of a public issue. Of course, if somebody wants the full version, nowadays it is available on the website. You can go through it. But at least for a quick reference, abridged version is good enough. It contains all the important features of prospectus. Okay. So that is abridged prospectus. So just like there is an abridged prospectus, there is an abridged letter of offer. So guess when will abridged letter of offer be used? Abridged letter of offer is used in case of right issue. It is an abridged version of letter of offer. And again it is sent to all the shareholders along with the application form. Nowadays, if you are registered on your email, you will find you get an email from the company and it contains all the details. Okay. What is self prospectus? This was also there in your law syllabus, I remember. Yes, first from your side. If they want to raise the money again and again, then instead of preparing, drafting, doing all the formalities again and again, you can just draft it once and use it again and again. It's like you keep something on your shelf. If required, you use it again. That is why shelf prospectus. It has a shelf life. Okay, but again, it is not available to all companies. It's not available for a very long period of time also. Is it right? So let us see minutely what is shelf prospectus. It is a prospectus which enables an issuer to make a series of issues, but there is a time limit within a period of 1 year. You can't use a prospectus of 10 years ago under the name of shelf prospectus, so 1 year is enough without the need of filing a fresh prospectus every time. And this facility is also available to limited set of issuers like public sector bank, scheduled banks, and public financial institution, because they may need to raise funds more often. So every time if you do the filing of prospectus, it is again time consuming, costly affair. It might be derogatory. Why derogatory? There is a flaw in their planning. Plans are going to change actually. You can't predict future. How can you predict what will happen after 6 months? And because these are financial institutions, they are more in the need of funds. Some big client comes and say, I want to acquire this company. I need 4,000 crore rupees urgently. So then they will have to raise the funds. So they must have thought about this, that these banks and FIs, they need funds more often than other entities. That is why for other entities, they are not allowing. For other entities, they should be careful in the project cost calculation. Other entities need funds for their project, but these entities need funds to fund others. Hence, to save time, this is a provision given. And the last is placement document. It is an offer document for the purpose of whom? Qualified institutional placement. This placement document is given only to QIP and it contains all the relevant and material disclosures. These disclosures etc. are given in the SEBI guideline. Okay. All disclosures that you need to give are given in the SEBI guideline. Now next paragraph is key disclosure requirement of offer document. So what are the details you have to give in that offer document? Oh, there is a long list. My God, how do you remember? How did you manage to pass intermediate? Did you remember so much? No. Then memory technique. Huh? Memory technique for everything. But how do you remember which technique will be used when? That also you remember. Luck. That's good. Combination of memory and understanding and luck. Wow. I wish I also could have done that and I would have got a better rank. Fourth rank was not good enough for interview. Only on studies basis somehow. Yes or no? Write again. Sorry, brother. You take my degree again, but I will not write this exam again. No, no. You take everything from me, send me to Himalaya, but don't ask me to appear for C exam again. Okay. So come to point number next, key disclosure requirement of offer document. Now I'm going to go through it quickly because this is just a long list of disclosures, and you should know that in case if they ask a question on disclosure requirement on offer document, you have to come here and accordingly write. But there are multiple choice questions, so understand it, and then you will be able to identify which is the right or the wrong answer in a given set of questions. Okay. So you can't take it lightly because then you have to go through each line to check what is the correct answer of a multiple choice question, fill in the blanks question, true false question. Key disclosure requirement to be made in the offer document is given below. Under that, name and address of the registered office of the company, company secretary, CFO, auditor, legal advisor, banker, trustee, if any, underwriter. Because trustee would be for debenture issues. For share issue, you don't have trustee. Then date of the name and address is written. Address means residential address only of individual, and wherever it is an entity will be the corporate office. Okay. So that means it puts a lot of pressure on these people to give correct disclosure. Dates of opening and closing of the issue and declaration about the issue of allotment letters and refund within the prescribed time. So when will allotment letters be mailed? When will refund be initiated? All these are mentioned. Then a statement by the board of director about the separate bank account where all money received out of the issue are to be transferred, and disclosure of details of all money utilized and unutilized money out of the previous issues. Next is detail about underwriting of the issue. If there is any underwriting, you have to disclose that. The authority of the issue and the details of the resolution passed therefore. Then procedure and time schedule for allotment and issue of security. Capital structure of the company. Main objective of public offer and terms of the present issue. Main objects and present business of the company and its location. Schedule of implementation of the project. Particulars relating to management perception of the risk factors specific to the project. Gestation period. Extent of progress made in the project and deadlines for completion of the project. Minimum subscription amount payable by way of premium, issue of share otherwise than on cash. Details of directors including their appointments and remuneration, and then sources of promoters contribute. These are the key disclosure requirement in offer document. Is it right? In all these documents, these details will be given, and in some documents, some additional information as per the respective provisions you have to give. So this completes my discussion on the different types of offer documents and the disclosure requirement for offer documents. Now another interesting part of this chapter is issue requirement. Read this. Tomorrow you will also come out with a public issue. You will require this chapter. Okay. I am reading it very carefully because I plan after 3 years to come out with a public issue. How many years? 3 years. Okay. Contact us for what? For advisor or investment? As a merchant banker. Oh, I don't mind. Charge me lower fees. Okay. So now we'll take a break.